Upfront Mortgage Insurance (UFMI). UFMI is an insurance premium that is collected typically on Federal Housing Administration (FHA) loans at the time the loan is initially made. Though similar, it is not quite the same as private mortgage insurance (PMI), which is collected by a conventional private mortgage lender each month when a buyer's down payment on a home is less than 20% of the purchase price. Upfront mortgage premiums are added to a pool of money that is used to help entities such as the FHA insure loans for certain borrowers. Like PMI, the purpose of FHA mortgage insurance is to protect the lender. When borrowers have minimal equity in their homes, the risk that the borrower will default is higher because the borrower doesn't have as much to lose by walking away and letting the bank foreclose. With mortgage insurance, if you stop making your mortgage payment and walk away from your home, the insurer will help your lender recoup its losses. FHA loans have lower down payment requirements, as low as 3.5% of a home's price tag, and less stringent income and credit requirement than conventional loan. So this loan requires the payment of upfront mortgage insurance, which is collected at the time of closing. Since 2015, the rate for upfront mortgage insurance has been 1.75% of the base loan price. FHA streamlined refinance loans are charged at UFMIP of 0.55%. You have the option to pay this amount in cash when you close your loan, but most people choose to roll it into the total mortgage amount. If you can afford to pay the amount of upfront mortgage insurance (UFMI) at the outset, it's a good idea to do so. If you decide to roll it into your loan, it will be a lot more expensive in the long run. In addition to the UFMI, borrowers have to pay ongoing mortgage insurance premium, which range from 0.45% to 1.5% of the total mortgage. You will have to pay this mortgage insurance until your loan-to-value ratio is low enough. That is, until you have paid off a certain amount of your mortgage. When your equity is high enough, there is less risk for the lender should you walk away from the loan. At this time, the insurance is no longer required. Those with loans greater than 15 years are required to make monthly mortgage insurance payment for 5 years. If your mortgage is shorter than 15 years, then the only requirement is 78% loan-to-value ratio. Upfront mortgage insurance premium payments are submitted directly to the U.S. Department of Housing and Urban Development and collected by the U.S. Department of the Treasury's Automated Collection Service. They go into an escrow account. HUD uses a secure internet collection portal to process collection electronically. This automated collection service satisfies agency and business partner demands for electronic alternative by providing the ability to complete form, make payment, and submit queries electronically via the internet. Enables business partner and consumer user to access their payment account from any computer with internet access. Enable federal agencies to obtain and process collection in an efficient and timely manner. Special consideration. Many people do not realize that premiums for upfront mortgage insurance can usually be refunded on a prorated basis if they paid it all at once, and then sell their home within the first 5 to 7 years of ownership. In other words, they may be entitled to a substantial refund even years after the fact. If a homeowner receives their FHA loan before June 2013, they are eligible for a refund and cancellation of their upfront mortgage insurance premium after 5 years. A homeowner must have 22% equity in the property, and all payment must have been made on time. Homeowners with FHA loans issued after June 2013 must refinance into a conventional loan and have a current loan-to-value of at 80% or more. Tips to avoid paying upfront mortgage insurance. There are a few ways home buyers can avoid paying upfront mortgage insurance. Apply for a conventional mortgage loan. Mortgage lender will not require upfront mortgage insurance for conventional loan that have an 80% loan to value or less. Thank you.